This is Connie, and for the affirmative. So according to statistics obtained by National Bureau of Economic Research, 40% of American households felt financial distress between the 17-month period after the financial crisis. The affirmative believes that this can easily happen again due to the latest U.S. economic news for the following three reasons: lack of transparency from securitization, reckless monetary policy, and political crisis. So securitized assets were in fact what economists have been referring to as toxic sludge or toxic assets, and have highlighted as the main conductors of blind investments on wealthy capital. Securitization relies on slicing up debt and credit and rebundling it into packages and offering them to investors. So the argued benefit of this is that rebundling securities buys tons and expensive credit, but in fact, by decreasing credibility in the system, securitization threatens the very foundation on which our economy runs today. So in fact, it leads to spiral inflation as a direct result of broad lack of trust in the system, with consumers switching from money and credit to real estate capital, sort of wealth. So in addition, securitization of assets spiked in 2013 and continues to rise. And the securitization of assets include the asset-backed securities, the ABS, and the mortgage-backed securities, and these are aided by the collateralized loan obligations. So the main reason why securitization does not work is simple: it's a mild type of fraud, and it fosters financial transactions based on asymmetric information regarding the very assets being banked on. And secondly, the U.S. government is re-implementing a phony economy that's completely dependent on the ability to borrow money, and they have no way of paying them back. So the U.S. government finances the debt by printing more money, which causes inflation and consequently reduces the value of money. So the International Monetary Fund's chief economist addressed concerns of potential major disruption in the global financial markets if the U.S. did not raise their debt ceiling. U.S. dollar is a major world currency in the foreign market, and roughly 40 to 60% of international financial transactions take place in dollars. However, the U.S. Treasuries are continuously losing their credibility due to the federal endless money printing, and thus they're losing foreign investors. And so everyone is trying to get rid of their dollars while the U.S. is printing more money to pay off their debt. And so as a result, the cumulative deficit leads to an even higher debt and economic downturn. So thirdly and lastly, so this debate has been dedicated to approaching this topic from an economic point of view, but we believe that it's reasonable to consider it from another point of view, which is politics. The affirmative side believes that the fundamental issues from the 2008 crisis was the 2008 crisis still remained due to the lack of worthy government policies. So for example, the Dodd-Frank Wall Street Reform and Consumer Protection Act was signed by President Obama in 2010, which includes the Financial Stability Oversight Council, which was supposedly established to monitor the marketplace and bank holding companies. The problem with such programs is the trustworthiness in the disclosure of information by the politicians. The members in office have been sentenced to remain silent to prevent losing their chances in the next election. So the heightening competition between the Democrats and Republicans lead to the inefficiency in such councils and many other government policies, including monetary policies that were made to prevent another global crisis. So these continuations of these continuations have been the reason for another global crisis.
All right. Good afternoon. My name is Rob, and first off, I'm going to be introducing our argument that we're essentially saying that the U.S. government's economic measures since the Great Recession of 2008 have effectively stabilized and grown the economy, as well as ensured another recession will not happen in the future. And essentially, to begin, I will be talking about the fiscal and monetary policy and how effective they've been since 2008, as well as some financial regulations that have been introduced. And Tamer will finish it off by saying how this will prevent another crisis. Now, the Great Recession of 2008, it has been the biggest financial downturn in the United States since the Great Depression. It is so significant that the U.S. government was forced to implement financial measures, including fiscal and monetary policy. Now, to begin, I'll be talking about monetary policy and how unconventional monetary policy has been successful through quantitative easing. Now, because when a recession occurs, the economic stimulus is necessary, and to provide economic stimulus, lowering interest rates can allow this to happen. Now, first in 2008, the Federal Reserve reduced the overnight rate as much as possible to try and effectively stimulate the economy, but this did not happen enough. So they implemented quantitative easing, which is essentially when the Federal Reserve buys short-term. It started out buying short-term bonds, so treasury bills, to try and increase the monetary base, lowering interest rates even further and stimulating the economy. Now this has, there have been three steps to this: first short-term, second long-term bonds, and now credit default swaps. Now over the past few years, this has successfully lowered the interest rates, and consumption has gone up in the economy. Personal income expenditures are up 10% since 2007, GDP growth has been stable, and unemployment has gone down to 6.7%. So what we see is that these monetary policies have been effective in ensuring that the U.S. economy has recovered from the Great Recession. Now moving on to fiscal policy. Obviously, there is a great debate as whether or not the U.S. should have bailed out banks such as AIG, and we will talk about that later. But first of all, after 2008, the government implemented personal tax rebates of $300 to $600. And this directly increased consumer spending in the U.S. of $33 to $80 billion annually. So we can see that this government spending has increased GDP and decreased the recessionary gap. Now moving on, they also implemented something called TARP, which was the Troubled Asset Relief Program. And now we believe that this prevented a total and complete collapse of the auto and financial sectors. Now, what we believe as the opposition side is that the risk of a moral hazard is significantly less than the risk of the financial system collapsing completely. So, if we hadn't bailed out AIG, the whole financial system would have been a complete mess. There would have been chaos, there would have been no trust in the system, and as we know, the U.S. economy is completely built off of trust. So, and one thing that the U.S. government has done to combat this supposed moral hazard is through the implementation of strict policies on these banks. And they've required minimum capital requirements, which reduces overall risk in case of losses, as well as in terms of derivatives, they force the seller to retain 5% of the risk. So now sellers of derivatives will be less willing to sell risky assets, which obviously decreases the risk of the whole system. And through this monetary policy of quantitative easing, reducing interest rates, and increasing consumption and stimulus in the economy, the U.S. has effectively allowed the economy to recover from the 2008 crisis. And another thing in terms of, I'll be moving on to financial regulations, specifically through the Dodd-Frank Act. One of the reasons for the recession in the first place was due to subprime mortgages and how easy it was to get mortgages. And they've addressed this issue banks are being forced to consider personal income, credit history, as well as debt obligations of people. So subprime mortgages, these risky mortgages, have significantly decreased since 2008, and thus decreasing the risk of another recession. And with that done, I'll let Timur.
I'll just quickly note, just in strengthening Rob's claim that how prudential supervision on the financial sector has also contributed to the increasing levels of consumption and investment and to this growing economic growth of the American economy. New legislative bodies were created, like the Financial Oversight Council and an improved financial deposit insurance. These regulations have made sure that there would be efficient control on the evaluation of systematic risk, reserving adequate capital. And just to quickly finish off, there is always risk that there will be disturbance to the financial sector. And keeping that in consideration, the promotion of the international LLR, the lender of last resort, was put into place to open the opportunity to reduce liquidity risk and to establish consistent information.
Okay, so
Free bottle?
yes.
My name is Ivana Lutevets, and I would like to raise some of the points brought up by the opposition, as well as prove why they're either flawed or have become obsolete by 2014. One of the main arguments is that whenever there have been institutions that are meant to ensure the security of our financial system, these have failed to uphold the standards that they were meant to protect. One of the examples mentioned is the Basel Committee, which is an international group overlooking the security of banks all over the world. And they have, as of February 10th of 2014, they have actually diluted some of the measures that they considered to regulate banks and how much capital they can hold against the loans that they make out. So this being the crude and broadest measure that we can take to control banks and how much they loan out, we can see that the deductive system that we are using instead fails to actually protect our financial system. Basically, banks aren't asked to disclose the information on their balance sheets anymore, which is the only change that we had enforced right after the 2008 meltdown. And this means that it's not only not uniform, the information that we get, but it's also, which brings a whole negative externality of asymmetric information, but it's also, because it's not compulsory, the only way for us to deduct the risk, the leverage ratio is out of, it's basically a deductive system, which means that the riskier the assets that we put out, the better banks will do. The second problem is that standardized equities are coming back, and the problems with standardized equities is that they are bringing back the subprime housing, the subprime mortgages, and this will also, as we mentioned in the opening, this brings in a problem of mixed signals. And moving on to the monetary and fiscal policy arguments, the opposition has mentioned that the moral hazard is not as important. However, we can see that in terms of monetary policy, lowering the overnight rates and quantitative easing, they have failed so far to spread into longer term assets, which shows that we have failed since 2008. We have failed to reinstate. The trust in the system on which our financial
Or not, up to you.
Yeah.
basically reduced capital requirements on assets and the bailouts, which bring the moral hazard. They show that
with that, the open dialogue between markets and investors has failed to be rebuilt.
Alright, yes,
Rebuttal.
I took 3 minutes, so you can take 3 minutes. Can stay there for voting.
Earlier, the affirmative stated that the current monetary policy was causing inflation, and it's important to keep in mind that when you state that it's causing inflation, you imply that inflation costs are attached to monetary policy. And such a cost, which you also mentioned, was the devaluation of money, or the decrease in value of money. However, the current inflation currently in the U.S. economy is 1%, well below the target of 2%. And it's also important to know that the credit system is healthy in the American economy as a reflection of the monetary policy, when you keep in mind that the U.S. economy is targeting at 1%, and it shows no signs of distortions in the credit system. In addition, because of the financial regulations, this prudent supervision of the financial regulations. And earlier, you also stated that it would cause unemployment, and we've stated earlier that the employment rate currently is decreasing, showing great recovery sign from the Great Recession, which is only a reflection of the